Good morning. This is this introduction and the first part of the presentation for this webinar is a re-recording due to some technical difficulties. However, the panel discussion is as it was originally recorded. Hello, and welcome to this ID Insight webinar. My name is Suraksha Sharma, and I'm a manager at ID Insight, working on some of our financial inclusion projects. I'm really pleased to kick off this part one of this two-part webinar series on financial inclusion. Over the past 2 years, the financial inclusion team at ID Insight has been using behavioral and experimental methods to produce evidence on programs and nudges that can improve the access to financial inclusion services. We've produced evidence on a variety of topics, including the banking agent network, communications to include access into financial inclusion schemes, and of course, the digital payment applications work that we're going to talk about. With this webinar series, our goal is to share some of these results and bring in other experts to discuss the implications and applicability of this evidence. Today's session will kick off after a 20-minute presentation on an experimental study that we conducted in collaboration with Good Business Lab and which was funded by the Bill and Melinda Gates Foundation. The study aimed to understand if training female migrant workers to use digital payment applications could lead to an increase in their usage of these applications to send remittances back home. After the presentation, we will launch into a 30-minute panel discussion where we will discuss the reasons for low uptake of digital payment applications, especially among poor and vulnerable populations, despite its many benefits. We'll also talk about the barriers that these populations face to accessing digital payment applications and potential solutions for improving usage. Finally, we will discuss if and how digital payment applications can be leveraged to mitigate the impacts of external shocks, especially like the COVID-19 pandemic. Joining us on this panel today, we have a stellar setup. We have Achyuta Advaryu, who is going to be our moderator for today's session. Ach is an associate professor of business economics and public policy at the University of Michigan Ross School of Business. He is also the co-founder of Good Business Lab, a research organization aimed at leading businesses to improve the lives of workers. Ach is one of the principal investigators for the study, the results of which we'll present later today as well. We're really pleased to have Ach with us today. Next, we have Anjali Bansal, who is the founder of Avana Capital, a platform that invests in and supports the scaling up of startups. She has mentored numerous startups and is the chairperson of the Investment Council of Niti Aayog's FinTech and Women Entrepreneurship platform. Anjali wears multiple other hats that I'm excluding right now in an attempt to keep this introduction short. But welcome, Anjali, and thank you so much for joining us today. We also have with us Indradeep Ghosh, who comes from Dwara Research, where he is the executive director. Dwara Research, by the way, does some fantastic work on financial access and policy, all stewarded by Indradeep. Indradeep also has a background in economics, including a PhD from MIT, and his research in recent years has focused on the Indian economy, and specifically on financial inclusion. We're really pleased to have Indradeep joining us on this panel as well. And last but not the least, we are extremely excited to welcome Sanjay Jain. Sanjay is the Chief Innovation Officer and Partner at the Center for Innovation, Incubation, and Entrepreneurship, CIIE, an organization that incubates technology startups. He's also a partner at the Bharat Innovation Fund and the Bharat Inclusion Seed Fund, where he supports innovation and products at scale. Sanjay was previously the Chief Product Manager at the UIDAI during its formative years and has a lot of deep experience with IP-led innovation and scale-up. Welcome, Sanjay. Thank you so much for joining us. That's our panel for today. After we complete the moderated discussion, we will open it up for Q&A with the audience, and we anticipate that that will last for the last 30 minutes of this session. So it's a full jam-packed session, and so without further ado, I'd like to hand this over to my colleague Ishita Batra, who will present results from our study on leveraging digital payments for remittances. Over to you, Ishita.
Thanks, Sonakshi. Hi, everyone. It's great to be here. So today I'm going to be presenting the results from our study on training female migrant workers to use digital payments for remittances. I'm just going to share my screen. There we go. Yes, so this was a study we conducted in partnership with Good Business Lab, and it was an impact evaluation to see whether training female migrant workers to use digital payments for remittances had an impact. In this presentation, I'm going to describe the context for the study, the evaluation design. We'll then dive into the results, and finally, I'll describe the conclusions from the study. So to start us off, I'm sure everyone knows the various benefits of digital payment applications. They're free, they're safe to use, and anyone can use digital payment applications to send and receive money at their convenience. There is a variety of digital payment platforms available in India, such as mobile wallets, UPI applications, and banking applications, all of which are free to use and allow money to be transferred instantly and securely to another bank account or mobile wallet. However, in spite of these advantages of digital payment applications and the variety of platforms available, we see that the use of digital payments in India is quite low. Per Findex 2017, only about 30% of people reported using digital payments in the past year. Additionally, the use of digital payment applications is concentrated among the rich. Thus, there's an opportunity to encourage the use of digital payment applications in India, especially in light of COVID-19, where there's a need to send money to people located far away, and it's also safer to conduct cash-free transactions. In this study, we focused on migrant workers as they are a population that can particularly benefit from digital payment applications. As you might know, migrant workers are an important part of the Indian economic story. India has over 100 million internal migrants, and they are largely left out of the fold of the formal economy and digital economy. Digital payment applications offer a way to remove one potential source of vulnerability for these migrants. Migrant workers can benefit from using digital payment applications for remittances. It saves them time, it saves them money, and it is a safe channel for sending money. We also thought that making the process of sending money home easier could reduce stress related to finances. However, in spite of the various advantages, these applications remain underutilized for internal remittance. Only 7% of remittance in India was sent using a mobile phone in 2017. So we thought that there's a social impact opportunity in encouraging migrant workers to use digital payment applications. This is particularly salient in light of COVID-19, where migrant workers would need to send money to family or receive money from family located far away, and it can also be a channel for accessing relief funds. Through our collaboration with Good Business Lab, who works closely with Shahi experts, we jointly decided to work with a group of female migrant workers from Shahi. So a little bit about Shahi. It's the largest garment manufacturer in India. Shahi employs more than 100,000 employees, about 70% of whom are women. We recruited a sample of 600 female migrant workers from Shahi's factories in Bangalore. And we broadly saw similar trends in this sample compared to the general remittance and digital payment trends. Remittance is a very important transaction for this sample, but digital payments are extremely underutilized. Only 5% reported using digital payments to send money home in the past month. Generally, people conduct what is called an over-the-counter transaction to send money home, which is where they pay an agent or a shopkeeper in cash and ask them to transfer that money to a recipient's bank account. We thought this population can leverage digital payments a lot more and wanted to see if there was a way to improve take-up. We did some qualitative work to understand what were the key reasons why people were not using digital payments. And we diagnosed lack of knowledge and lack of trust as key barriers. We built a program to address these barriers and then tested to see whether this program was effective in increasing use of digital payment applications. Let's learn a little bit more about this sample. So the main reason why for 95% of the sample, they'd migrated to support themselves and their families. And this is why sending money home is really important. About half the sample is from Orissa and speaks Oriya. And most of the sample has completed some level of formal education. Notably, more than half the sample has completed class 10. The average age of the worker in our sample is 24, and almost all of them are not married. Something really important to note is that we chose a sample such that everyone in the sample had a smartphone. This is because the digital payment application we trained them to use works only on smartphones. Because of this, we do recognize that this sample is not necessarily comparable to the larger migrant population because many of them do use feature phones. Let's dive into the evaluation design. Our program consisted of training and reminder SMS messages to use a digital payment application. The application we used was Bima. The Bima app uses a technology called UPI, which, in case you're not familiar, allows you to send money using your phone from your bank account directly into somebody else's bank account. There are many applications that offer this UPI functionality. There's Bima, there's Google Pay, there's PhonePe. We chose to use Bima specifically because the interface was relatively simple, and most importantly, it offered an interface in Odia, which is the language about half of our sample is most comfortable in. However, we do expect our results to be generalizable to UPI applications in general because all of them offer very similar functionalities. And again, this is why we recruited a sample that had smartphones, because this application works only on smartphones. Our program consisted of a training session provided at the workplace at the end of the workday. Workers at Shahi were given information about what a digital payment application like Bima is and what it does. This training session was very interactive, and they were provided with a guided walkthrough where the trainer guided them through every single stage of how do you find this application in the App Store, how do you download it, how do you set up an account, and finally, how do you receive and send money. Workers who were successful in setting up an account during the training session were given ₹50 and encouraged to send money to others in the room so that they could become familiar with the interface so that the remittance transaction would be easier for them down the line. The other aspect of our program was SMS reminders. We sent workers an SMS reminding them to use UPI applications like Bima or any other digital payment application to send money home and for other payments. This SMS also included a link to a YouTube video reviewing the steps of sending money using the Bima app. We expect the results of this study to be generalizable to other UPI-based applications since they all offer similar functionalities. And again, this is why we deliberately chose smartphone users, because this app works only on smartphones. So the program itself consisted of a training session at Shahi factories. At the end of the workday, workers were given a training session where they were told about what UPI Bima is and how it can be used. This was an interactive guided walkthrough where they received support at every stage of the study. The trainer explained how do you download the application, how do you set up an account, and how do you send money using this application. Workers who were successful in setting up an account during the training were also provided ₹50. And we encouraged them to send money to other people in the room so they could get really comfortable with the interface. The other aspect of our program was reminder SMS messages. We sent workers an SMS reminder letting them know that next time you need to send money home or make a payment, you can use a digital payment application like Bima. And we also included a link to a YouTube video that just reviewed the steps for sending money using Bima. To test this program, we conducted a randomized control trial. Our research question was, what is the effect of workplace training sessions and reminder SMS messages on use of digital payment applications, particularly for remittances? The timeline is here. Note that this was before the COVID-19 pandemic hit India. Another thing to note is we've defined digital payment applications as using your phone specifically to send or receive money. So this means mobile wallets, it means UPI, it means your bank application, or even opening a web browser on your phone to access your bank account. The reason why I'm making this distinction is that digital payments often include debit and credit cards, but in our study, we were specifically interested in using the phone only. In our randomized control trial, we started with a sample of about 600 workers and assigned them to 3 treatment arms of 200 people each. There's the control group, the classroom treatment group, and the individualized treatment group. And at the end of the study, we compared outcomes across these groups to estimate the effects of our program. So in the control group, no intervention was given. It was business as usual for them. The classroom treatment group received what we call a classroom training session and a reminder SMS message. And the individualized treatment group received a more personalized training session and a reminder SMS.
So the key difference between the classroom treatment and the individualized treatment is that is just the level of support workers receive during the training. In the classroom treatment, there's one trainer working with 20 to 30 people, whereas in the individualized training, it's one trainer working closely with 5 people who can, and therefore more support is available and you can troubleshoot your issues with the trainer directly. So let's see the results of this study. We have 4 key results. The first is that the use of digital payment applications is extremely low. At the beginning of our study, only 6% of workers were using digital payment applications for any reason. 5% were using digital payments for remittances, and 5% were using digital payments for non-remittance purposes, such as online shopping or paying bills. Another thing to note is that those who use digital payments for one purpose tend to use it for the other. There's a large overlap between those who are using digital payment applications for sending money and those who are using digital payment applications for shopping or other reasons. The second key result is that lack of knowledge is the main reason why workers were not using digital payment applications. At the beginning of our study, we asked workers if they knew that they could send or receive money using their phone, and almost 40% were not aware of this. Of the 60% who were aware of digital payment applications, we asked why they weren't using digital payments. More than 90% said this was because they didn't know how to download these applications or they didn't know how to use them. So we see here how lack of knowledge is really holding people back from using digital payment applications. An interesting result to note here is that only 4% of people said that lack of trust was the key reason why they weren't using digital payment applications. Although lack of trust was a barrier we identified in our qualitative survey before conducting this baseline. This could be because in our quantitative survey, we asked them what the primary barrier was that was holding them back from using digital payment applications. And it's possible that given how limited their knowledge of these applications was, they may not have fully considered the issue of trust. Now, let's talk about the effectiveness of this program on key outcome variables. So our 2 major outcomes of interest are 1, use of digital payment applications in general, and secondly, use of digital payment applications specifically for remittances. So on the use of digital payment applications in general, the classroom training had a statistically significant effect of 5 percentage points, and the individualized training also showed a positive effect of 10 percentage points. When we moved to the effect on the use of digital payment applications only for remittances, we didn't find a statistically significant effect of the classroom training, but the individualized training was effective at increasing use of digital payment applications for remittances by 7 percentage points. Another analysis we conducted was comparing the classroom training to the individualized training. And we didn't find a statistically significant difference between the two, which is to say that the effects of both the trainings are largely the same when it comes to the usage of digital payment applications. So we now know that the classroom and individualized trainings were effective at increasing the use of digital payment applications, but this increase is quite small even though we address the knowledge barrier. At end line, the use of digital payment applications is only 11% to 16%. And in the next slide, I'll talk a bit more about some potential reasons why the increase was so small and why use is low in spite of addressing the knowledge barrier. So our 4th result is related to the mechanics of sending money using a UPI app. There's a host of requirements you need to meet to send money using Bima or any other UPI app. You have to have certain infrastructure in place. So your phone number needs to be linked to your bank account. You need a debit card. You need the correct SIM card in your phone, and you need to have balance on your mobile. And then there are a bunch of other steps you need to follow in order to download the application, set up your account, and ultimately send money. And all these steps have been put into place to verify your phone number, verify your bank account, and ensure security. However, these requirements can effectively function as hurdles that are difficult for a target population to overcome, which is something we observed in our training sessions. We collected data during our classroom and individualized training sessions to understand how many workers were able to complete each stage of the training. So in this graph, the x-axis shows the different stages involved in sending money using a UPI app, and the y-axis shows the percentage of workers who were able to complete each step. The red line shows the classroom training and the blue line is for the individualized training. So you can see that there's attrition at every stage. We start with 72 to 75% of workers who attended the training, but only 11 to 18% of workers were actually able to send money at the end of the intervention. We find that 45% of the sample actually dropped off due to infrastructure requirements. This is a key reason why success rates were low during the intervention. People either did not have a mobile phone did not have their phone number linked to their bank account, did not have balance in their mobile phone, or did not have the debit card or the right SIM card on them during the training, which meant that they were unable to set up the account and send money using digital payments during the training session. Now, let's compare the red and the blue lines for the individualized and classroom trainings. We see that in general, success rates for individualized training are as good as or only slightly better than classroom training. This is in spite of the fact that individualized training provided workers with personalized attention to troubleshoot their issues. So far, we've discussed the results from our main study. However, 1 month after we finished our end line, COVID-19 hit India and the country went into lockdown. We spoke to a sample to understand how they were doing in general and whether digital payments were helping them cope better. This is what we found. Most workers stayed back at the factory because they didn't have enough time to plan a trip home. Interestingly, only 8% of them remitted money. This is a sharp drop from endline. At endline, 59% of workers said they were remitting money. And it's even more interesting that fewer migrants were remitting money because they were still receiving a full salary from Shahi during the lockdown. Some preliminary reasons why workers were not remitting were largely because personal expenditures had increased. We're conducting another survey round to better understand this issue. Digital payments are related to the remittance story. Workers who already had a digital payment account were more likely to remit money compared to workers who did not have a digital payment account. Since having a digital payment account is correlated to our treatment, it provides some evidence that knowing how to use digital payments was helpful in coping with a shock to your finances and in general. We've collected a lot more information on these migrant workers and we'll be releasing a brief with these results shortly. We're also following up with workers to understand their behavior better. So, in conclusion, we see that knowledge barriers hold people back from using digital payment applications. Based on our study, it seems like a well-designed classroom training would be sufficient. This is good news for cost effectiveness and scalability, since it's easier and cheaper to conduct a classroom training than an individualized training. However, it's very important to address these infrastructure barriers in addition to the knowledge barriers if we want to see an effect on increased use of digital payment applications. Stakeholders can support target populations in meeting these barriers. For example, organizations who provide training on using digital payment applications can provide support to participants in meeting infrastructure requirements before the training session. For example, reminding them to bring debit cards to the training or facilitating phone number bank account linkage. Similarly, organizations who work with migrant workers can possibly communicate the utility of linking a phone number to a bank account and can even provide support in doing so. Something really important to note about infrastructural barriers is that they disproportionately affect those who are most likely to benefit from them. Groups such as migrants or women have unequal access to phones or may be less likely to have phone numbers linked to bank accounts. Such groups cannot avail of the benefits of digital payment applications because of systematic gaps earlier in the chain. This also relates to how in our study we could not work with feature phone users because the app we chose works only on smartphones. Finally, specifically for migrants, which is one vulnerable group we considered in our study, digital payments can offer many benefits, such as the ability to send money easily, to access formal relief services and finances, which can be particularly useful in the face of a shock like COVID-19. So in conclusion, we find that digital payment applications are not yet working very well for poor and vulnerable populations. And the question we're asking is, what can we do to change this? On that note, I'm going to hand it back to Sonakshi to kick off the discussion on how we can make digital payment applications work well for the poor. Thanks.
Thanks so much, Ishita, for presenting those results. I can see that questions are already pouring in related to this presentation. So before passing the stage to Achyuta, just wanted to, and before launching the panel discussion, just wanted to make a small note that you can submit any questions that you have related to this presentation as well as once the panel discussion is launched. And so there should be a Q&A box on the lower part of your Zoom window, and you can feel free to begin asking questions right away. and we'll try to get to them in the last 30 minutes of our discussion. I know Ishita went through our results fairly quickly, and if people are interested in some more technical details pertaining to the design, as well as how we ask certain types of questions, please feel free to ask the question here, or you can follow up with us later, and we'll be happy to discuss these results in more detail. But without further ado, I'd like to hand this over to Ach so he can launch the panel discussion. Ach, over to you.
Hi, so thank you, Ishita, for summarizing these results very nicely, and the trial, and also to Sonakshi and everyone else at ID Insight for putting this together, and also for the collaboration with Good Business Lab and with us as PIs on this project. It's been a wonderful experience. So I just want to start by sort of summarizing a little bit of what we have learned in this trial, talking a little bit about the sort of post-COVID crisis related survey rounds that we've done. And then I'm going to sort of pose a few questions to each of the panelists to get the discussion started. And then I will also be monitoring the Q&A box. So if you have a question for any of the panelists or for the study as we go along, please just type it into the Q&A box. I tried to answer a bunch of the questions that related to the study already in the Q&A just by typing while Ishita was talking. So great. So basically, as Ishita just explained, we ran this trial with the hope that different types of training could increase the use of digital payments technology amongst low-income migrant workers who are working at Shahi, large garment firm, with factories in Bangalore. The main takeaways, I think, as I think Ishita summarized well, are that the trainings indeed were able to improve usage of digital payments in this population, and in particular the usage of digital payments for remittance purposes. But so if you look at the percentage change, we did really well because we took a baseline of something like 5 or 6% and we tripled it. And so that's great from the perspective of actually generating sort of detectable impacts. On the other hand, we still have something like 80 to 85% of individuals who took part in the trainings actually ended up not being able to or willing to go through the various steps that Ishita outlined in actually setting up digital payments tech and then using it, for remittance purposes. So, I think there's some positives and some negatives here. On the one hand, it's possible to train people in the usage of these technologies. On the other hand, there are systemic barriers, institutional barriers that prevent widespread adoption in the way that we've seen other digital payments technologies take off in, for example, Kenya and the rest of East Africa with MPESA, or even closer to India, with bKash in Bangladesh, for example. So, I think there's quite a lot of work to be done in India. I want to mention one thing related to the post-COVID rounds that we've done. So obviously the COVID-related financial crisis, has hit every part of the economy in every corner of the world. But in particular, we've seen a lot of stories, tragic stories about migrants and, being stuck in cities essentially and wanting to sort of either go back home or sort of send sort of financial or other assistance back home to their families. And one advantageous feature of this trial was with that we actually were in contact with the population of migrant workers that we had run the trial with, and we were able to survey them in subsequent rounds. And so we have one round completed and another round is about half complete. Some interesting insights from those rounds. One, in the first round post-COVID, so this came sort of directly after the COVID crisis hit, remittances were down substantially. So many people were not remitting money. And the biggest reason why they said they weren't remitting as a result of COVID was that they had additional cash needs themselves. And, we don't know exactly what these cash needs were. One hypothesis that we're exploring is that usually they were sort of, several of their meals were provided on the factory floors. These meals were not provided during the time of the crisis when there was a lockdown period for obvious reasons. And I think that might have increased their consumption needs temporarily. What we're seeing in the second round, we've got half of the surveys in on the second round, and we're actually seeing a big uptick in digital remittances, and that's differential across the treatment and control groups. So turns out that the learnings from the trainings actually persist over time, and we're able to detect that. And with 50% of the surveys in the second round, what we're seeing is that there's been a big uptick in remittances over the as the crisis has evolved, and about 25% of the participants are remitting, and that's differential across the treatment and control groups in this trial. We also see that if you do remit, you're sending much more than you did previously. So the previous mean remittance every time that someone was sending was about 3,200 rupees. Now we're seeing folks sending more on the order of 4,500 rupees every time they remit. So they're remitting a lot more back to their families. And so, as is obvious, I think, in a lot of ways, this crisis is extremely dynamic, and we're seeing that play out with respect to remittances too. So that's something I'm going to discuss a bit with the panelists, and very eager to get all of your thoughts. So let me turn the discussion over to the panelists now. I think one really key feature that has been emphasized in what Ishita spoke about in general with the idea of digital remittances, as well as in particular with the kind of trial that we did, is that there are a lot of kind of institutional, technological, and sort of financial inclusion related barriers that prevent people from taking up the digital payments technologies in a sort of large scale way in India. I want to kind of pick each of the panelists' brains about this a little bit, but maybe we can start with Anjali. In your view, there's a lot of these barriers, and some of them may be necessary because they kind of relate to digital identities and linking with the right bank accounts, et cetera. Which of these barriers do you think is sort of necessary and kind of a fundamental part of integrating into a digital kind of payments world, and which do you think are sort of unnecessarily present and maybe sort of that the private sector might be able to tackle with sort of better technology and better administration of the tech?
Thanks, Raj, and Ishita, compliments to you and the ID Insight team. I think some very interesting insights there on both barriers as well as adoption. As the question you asked around what keeps people from participating more actively in digital payments and sort of financial inclusion through the digital route, I would say it's probably sort of three big divides. One is the big divide between the digital India and Bharat. So there is a digital divide between Bharat and India. A lot of our applications are still mostly English, although we are starting to see the development of lots of sort of vernacular applications as well as vernacular interfaces. So that is starting to shift and hence should improve access and thus participation. The other is a real issue around affordability and access to feature phones versus smartphones. So even if you look at the 350 million smartphones in India, and if you look at the income distribution, you will see a very clear skew towards urban, middle to upper income versus non-urban and lower income. And given that some of these features actually are very hard to put onto feature phones, and hence obviously business model opportunities sit right there, that is another divide which prevents the poor really from participating. And the third is the big gender divide actually. And the gender divide is very well known and researched, so I will not sort of go into all of that here again. But even in the digital usage, forget sort of financial inclusion, not just digital payments, but digital anything by women. And as we go down the socioeconomic strata, all of it gets compounded. So literacy, access and control of a digital device in a household. If a household has one digital device or one phone or feature phone or smartphone, it's just, the woman will probably have the sort of last call on it, unless it's a livelihood instrument for her. So literacy, access to digital device, and third is control on finances. So then when we put all of this together, really on the digital divide side, I think women and poor women particularly have a compounded effect.
Fantastic. Sanjay, I wanted to kind of follow up and get your thoughts. I think Anjali has outlined these barriers very well. What role do you see the private sector playing in sort of eliminating some of these barriers? And I guess in particular, sort of because the private sector has been involved in some of these digital payments apps in India, but I think with limited success, are there kind of fundamental problems with having the private sector kind of play the lead role here? Do we need public sector intervention? And sort of where do you see the mix of those two?
So thanks, Aj, for the question. And Anjali, I think covered the barriers really well. I do want to point out, I mean, the data that was presented was 2017, and we have payments in India growing at about 50% every year. So, I think that data will certainly have changed by now. So coming back to the public-private, I mean, when you think of UPI was built by NPCI. I was actually part of the team that helped to design and build it. And when we launched it on the feature phones, we also launched a USSD version of it, which allows people with feature phones to actually use the same payment mechanism, provided you still have the bank account linked and all of that linkage still stays, but you could go through a USSD interface, which is what Kenya uses, right? But that interface has not seen an uptick at all, right? I mean, from the launch to now, the usage per month has been flat while UPI has gone through the roof. And so we were really concerned about that. And in fact, to make sure that we were able to get more feature phone users to participate in the payments ecosystem, we, in fact, with NPCI, CIIE, and BMGF together ran a grant challenge to get people to build apps or get people to pay using feature phones. We just launched a challenge. We were running it from October, and the demo day was in the midst of the COVID lockdowns, so we did it virtually. And we have 3 winners, and there are actually 3 different ways in which they can enable feature phone users to make payments. One of them is through a smarter feature phone, then there's voice technology, there's missed calls. And it's fantastic to see that we actually have 3 different kinds of ways in which you can solve it. And this kind of experimentation actually belongs in the private sector, because you have the option to fail. I mean, people put their resources behind it, they try different things, not everything's going to work out. It's very hard to have experimentation go on the public sector. So the public sector was great for building the rails. They enabled a lot of the private sector to build these apps on top of it. So Bima is actually an app built by NPCI, but then PhonePe, Google Pay are private sector apps, right? So now I think is the time to sort of see how we can get more private players to come in and try and build on the feature phone or build it through IVR technology so that people can use these feature phones and make payments. And so we have actually 3 different folks who are now going to get the ability to try out what the ideas they have, which were selected by this jury, and go out and see what we can do. And that's going to be taking a lot of energy into it. And we are really hopeful we'll see results. The other thing that was mentioned was language tech. So which is actually more still related to both feature phones and smartphone usage. I mean, even if you have a smartphone and you only have the app in English, I mean, Bima is in all these languages, but not the other apps. And so you would want to actually have a different UX, not just language, different experience for these folks, because sending money is a very I mean, not complex task in the way Ishita described it, but still a very uncomfortable task, because if something goes wrong, you have no recourse. And it's very different than watching a YouTube video, right? So, so when you see this group of users use smartphones and do, watching video, etc., it doesn't translate to doing actions which, cannot be reversed. And that is where you need a lot more comfort factor, a lot more trust. And I think education is a big barrier, and which, the classroom training helps, but it's actually doing a few transactions, knowing that they can be, easily done right. And then also when something goes wrong, how do you fix it? That option is not very clear. And, it's not clear for most people who use a smartphone either. But the point is, a 25 rupee loss or a 50 rupee loss is not material to some folks, but is very material to this audience. So it is, something which I think, it's going to take a lot of other factors to come in to help bring that trust where people can do these transactions. And so I think, it's a whole range of activities that need to be done. And I think private sector innovations got to be at the heart of it.
Fantastic, thank you. Indradeep, I want to follow up with you and ask, if we do have the private sector at the heart and leading the charge on innovation, do we run the risk, as often happens in the private sector, of prioritizing profit over inclusion? Is there a trade-off, or can both these things go hand in hand? And do you see the private sector's kind of leading this charge as potentially risky in terms of achieving that goal of financial inclusion for the very poor?
Sure. So, I think that risks exist, dangers exist. But I think migration to digital can only happen if we take a balanced perspective. One senses that there is much more focus on the risks and dangers than on the gains, and perhaps disproportionately so. See, when we say risks or dangers, it could be that we are not really talking about the possible glitches in the system, because those will be there, those are there. COVID-19 is showing that they are there. But they are there for other reasons. They are not intentional. They are, I would say, errors of omission rather than commission. And I'll come to what I mean by that. But if by risks and dangers we mean frauds, phishing, etc., then I think we have to assess realistically the probability of these kinds of dangers. And I'm actually largely agnostic about how big they are. My prior is that they might well be outweighed by the potential gains. So then there's a trade-off there, which is, what is the right trade-off? And I'm not sure how to settle this question though. On the other hand, if you think that the risks and dangers are the sort of glitches in the system, the transaction failures, the exclusion rates, I think then the more important question is, who wants inclusion? If it is low-income households, then this is not self-evident. One would have to demonstrate to the low-income households the benefits of going digital before they will want inclusion. So then that is what we need to focus on, and that is not an easy task. It is very difficult. It will take patience and effort, and it will be costly. And this is something that really intrigues me. This is super relevant, I think, when we start talking about glitches in the system as the risks and dangers, because this relates to profitability. What really is the unit economics of digital payments? Does anybody know? In preparation for this webinar, I had somebody from my team look up the Nilekani committee report, the Vatal committee report, and the RBI's payments vision document for 2019-2021. And very specifically, just to locate meaningful discussions of unit economics. But we came up with very little. There is a tendency to look at different components of digital transactions in isolation from each other, and to propose that the government absorb these different cost components or subsidize them. Both the Vatal committee report and the RBI's payments vision document claim that digital is cheaper, but there is no detail on why or how. You know, it seems that the official perspective is that digital is cheaper because technology. But is that really so? You know, what about the high fixed costs upfront? If there are increasing returns to scale, then at what point do they start manifesting? And is the payment space really meant, you know, once all of the market dynamics have played out for some time, is it really meant for competition? I mean, real competition, not the perfect competition of textbooks, but the kind of competition where firms are actually setting prices, struggling to cut costs so that they can gain market share. I have not really seen much analysis of this question. I think that if we wish to talk about risks and dangers in the sense of system failures, then this is what we really need to start thinking about, which is what is really the unit economics, and is regulation creating a space for digital payments that is financially viable? And this question, at least I do not see it to be very high on the regulators or government's priority list. And this is problematic because the government and the regulator want financial inclusion, it wants competition, and yet it does not seem to care that unless FSPs are profitable, you're not going to get either. So rather than there being a trade-off between inclusion and profitability, I will state it as a impossible trinity, which is that I think financial inclusion, competition, and profitability constitute a kind of impossible trinity. And as long as you care only about the first two, which is competition and financial inclusion, you're going to get a mess, which is what I think COVID-19 seems to indicate.
Well, thank you. So let me just
step in on that one.
Yeah,
I was
go ahead.
trying to think about what Indradeep was saying and thinking about Kenya. And Kenya, you don't have competition. I mean, there's one or two providers in the digital money space, but you did have the other elements. It was private. There's inclusion and a profit motive, right? I mean, MPESA has been very, very profitable for Safaricom, and so you did have two of those elements. You didn't have the competition bit, and the regulator is trying to bring that in right now. The problem in India is that we have had the competition. We've had, a goal for inclusion, but you're right. I mean, the profit motive has become a little muted because, recently there have been issues with the MDR pricing that has been set. But other than that, I mean, before that, we have, a lot of the startups have seen payments as a gateway product where you offer payments for free and then, bring people in and offer them other financial services, which has pretty much been the China model. And so from that perspective, that has not allowed a lot of people to get into and try to bring in payments and digitize them. So so that's why we have the competition, right? And the RBI has actually not set anything on the MDR. I was part of the Nandan and Nikani committee last year, and we had made no recommendations around making the FSPs non-viable. The MDR decision came after that. So, but broadly, I mean, I think we can have viable FSPs provide payments at a reasonable price because we have the volumes to make it work. And I think, financial inclusion will come as a result because that's the only way to grow the market. And so private sector can make it happen.
Can I add to that as well?
Please, please.
See, as a believer in sort of the market forces will eventually work and they will work themselves out. When we think about the unit economics, and Indradeep, is such a terrific question, right? What are the unit economics? There will be the short term of the unit economics and somewhat VC fueled what we might see in the short term. We don't know what the medium to long term will look like because we aren't there yet. And as it unfolds, I think for probably the users of the system, of any digital payment system, their relative cost is not, they are not thinking about is the company going to make money. Their relative cost is versus their alternative, which tends to be the informal channels, whether of credit or of payments. And thus for a user, if there is ease of use, then the lower cost will absolutely make sense and will thus promote faster and greater adoption of this. So what seems like slightly wonky unit economics in the short term for a lot of our fintech players may actually be what creates the market and promotes adoption. So that's kind of one point I wanted to make. The second point is, and I think what UPI has done has been absolutely brilliant. And they have demonstrated that it is possible to create a very open, new digital open architecture framework, the rails as Sanjay mentioned, on which a variety of market participants can ride. And so you will have payment providers, and because there is payment, so there is actually inclusion in the formal economy for all the participants. So it could be the poor. And Indradeep also mentioned, what is the incentive? Ultimately, people participate in market systems when there is gain to them. So what is the incentive? In some ways, the incentive is better discoverability and formalization in the credit system. So if whether it is the poor, and we are doing a bunch of work with MSMEs right now, as well as migrant labor, if it provides them better formalization and thus discoverability for credit and access to credit, that itself is incentive, but that will not play out in the first year of their digital transactions, right? It will take some time. So I would say let's give the system and us all some time. We are in the very, very early phases. And I think the private-public partnership, particularly on digital payments and digital finance in India, I think it's setting some very interesting sort of yardsticks. It's the only place in the world where we have an NPCI, UPI-like system, where we have Bima. And while Bima was the first off the block, today it's actually, again, market forces taking over, Google Pay, etc., are much larger.
Yeah, so this is a really interesting discussion, and Indradeep, you framed it really well, thinking about the unit economics. I think just to add to this a little bit, I do think there is the idea that perhaps there is some fixed cost or upfront cost that has to be paid and gains are delayed in this sense. One great point that Anjali, you made was with respect to the sort of formalization that takes place when you enroll in a program like this, that gives you sort of visibility to the credit systems, that gives you sort of like an ability to build up formal credit over time. And I think, that's a sort of a much longer term process than any one study can measure. That's sort of a systemic process. I do think, so, in addition to the sort of unit economics of the actual technologies themselves, there's, from our study, we're doing some preliminary calculations related to how much the trainings cost and sort of how much bang for the buck we can get with the trainings, depending on, the current usage rates that we measure in the study. So, according to that calculation, it's actually quite expensive for every, individual that we get to adopt digital remittance technologies. The price tag for either of the trainings, I think, is a little cheaper for the classroom setting, is in the order of 2,000 to 3,000 rupees per adopter. And so, I think that speaks to the idea that you might have to pay this upfront cost, which is only going to be amortized by the users sort of over time. So if you asked, the average low-income potential user to take up training and pay for it, they would likely say no, because the sort of, gains in terms of the fees that you save, and then sort of longer-term stuff with the financial system integration, that's going to be, realized over a long period of time. There may need to be some sort of upfront, posting of that payment by either, a public partnership or by the sort of tech companies themselves, that sort of understands that you need, I think the Bcash model in some sense is telling in this sense, because training and the sort of infrastructure around support is very much sort of codified in that model and seems to work quite well in the Bangladeshi setting. This has been a great discussion. I want to turn this a little bit, thinking about barriers. One can't help but wonder, since the world is turned upside down because of the COVID related economic crisis, what do you all see as potential opportunities that this has generated in the private sector, as well as potential sort of risks or costs that that arise that kind of make it more difficult to do work in this space. I think one thing that might help frame this is that a lot of the value of these technologies has been shown, at least in the sort of African setting, across multiple studies, to be related to consumption smoothing. So the idea is not that you save so much in fees by doing this, because often you can find pretty low fee providers that'll transmit money for you. It's more, I can send money whenever and wherever I want to, and I can send $1 or I can send $5, and I can do so cheaply. So that flexibility allows for more consumption smoothing and distribution of resources across financial networks. So as COVID threatens the sort of lives of so many families and so many financial networks come under distress, do you see an increased opportunity in terms of the value of consumption smoothing? Do you see additional challenges? Maybe we can start with Sanjay on this one, and then feel free to jump in.
Sure. So during COVID, I mean, I've been in touch with a lot of players in the sector, and what they tell me is that bill payments, mobile top-ups went up because there was no way to do it in cash, which people are doing easily. So people who had access to smartphones figured out how they could use those to do both of these transactions online, and so number of users actually went up, though the overall value and volume of transactions went down because of the other spending going down. But these two types of transactions certainly went up, and it brought new users into the fold who we hope will sort of do more transactions over a period of time. The fear is that it will increase the digital divide, because now while we have some new players coming in, the people who've been left behind are probably further behind than where they were before this thing happened. And so that is one of the worries from the COVID perspective. But I think if people see others doing well, as an example, and you follow, I hope that will lead to more change because the incentives are there. The other piece was related to agent networks. And we have seen a massive uptake of financial services through the agent networks here in the country. Again, these are all conversations I've had with folks, and they basically keep telling me that previously when a much smaller fraction of their agents were active, suddenly during COVID, 100% of their agents became active, and the amount of cash transactions went up. So cash in, cash out transactions went up considerably. Remittances flowed in the opposite direction, where people from villages were sending money to the urban areas, where it's typically been the exact opposite. So we've seen, an uptick in usage across the board. Some of it doesn't count in the digital sense, but it certainly, I think they've come back to the formal system and used it in ways that they were not doing before, and which I think is a good thing for inclusion.
Thank you. Anjali?
So I'll build on what Sanjay said. Actually, very similar, both anecdotal conversations as well as the data we have seen with some of our companies. Let me start with the anecdotal piece, really. One of the things that has become apparent through work we have done with sort of e-Kirana and digitizing the Kirana. So the whole MSME, the long tail, the last mile of grocery in India has been mom and pop. And largely not digital, really. So they may have mobile phones and so on, they accept orders, but not really digitized. We've seen a huge appetite and almost sort of a sense of urgency for digital adoption in that segment. And this segment has previously held back for various reasons. One is there was they didn't have any economic incentive to really participate. They did good business, they didn't need it. And there was a hesitation and about formalizing and having their data, particularly their revenue and tax data, etc., become visible to the system. But in a situation where there is no alternative, we were actually working with some of the largest industry associations, and the sense of urgency of if we don't digitize now, we will be left behind was palpable. So that's one. The second thing is in our everyday life, and if you talk to almost any household, urban household in India right now, their bhaji wala, doodh wala, bread wala, so everybody adopted digital payments because you could not transact in cash. Right? Cash is a carrier of the virus, etc. So even folks who had a feature phone, they found somebody in their family or their neighbor with whom they could get their customers to do digital remittances. So I've actually seen a very significant acceleration of digital adoption by Bharat, not by India alone. Now, India, of course, has gone completely digitally online on education. So consumption of education, consumption of healthcare has all moved online because you can't do it physically. So COVID in some ways will probably accelerate. Now, from the companies that one has seen, like one of our companies, actually a digital insurance distributor, when the lockdown happened, they rolled out a remote call center capability in sort of 2 days flat. They were back to 100% production in 7 days. The trend is so, and Sanjay, what you were saying about agents and the productivity utilization of agents, remarkable. They found that there were actually people signing up to become agents with them because now folks are sitting at home. They don't actually need to go anywhere. And in fact, the number of women that want to do this 4 or 5 hours a day versus doing it full time, they're seeing inbound interest to become agents with them. So I'm somewhat optimistic. COVID has been sort of fairly catastrophic on the human level, on the economic level as well, but there is hope.
That's very interesting. So let me just follow up and ask, related to the agents, you know, what are your, you both mentioned the sort of like capacity that agents might have to really drive this adoption and drive change. You know, what do you think are sort of best practices for structuring the types of incentives that agents have? How do you kind of align their incentives best with adoption and sustained usage?
Anjali, you want to go first?
I actually want to take incentives in a different way. One of the programs that saw massive adoption was the Jhan, Prime Minister Jhan account Yojana. Because all direct benefit transfers actually go into the Jhan account. All DBT is now happening digitally. So if there is a real incentive and a benefit, people will sign up and they will find a way to sign up, regardless of how complex it is. What worked quite well, and Sanjay, you should actually speak to this really, is the fact that the government machinery, so whether it was schools or block development officers or health workers, they were all deployed to enroll and onboard people onto the Jhan Yojana. So there are creative ways of using existing machinery. It doesn't necessarily have to be a BC who can do something digital on financial services or payment side. It can actually be a vast network of established network that can be repurposed to promote both education, training, and onboarding.
Yeah, no, so I completely agree with that. Is that, you know, we've seen this happen during the Jhan Yojana launch and even during demon times when a lot of Asian networks were repurposed. You know, you had, you know, Anganwadi workers. You had all sorts of folks in the field who were helping to spread the message and bring people into some of these systems. And so that has been something which has been very big. But the reason for the agent networks really is because bank branches are very expensive and this customer base has traditionally been very expensive to serve. So you couldn't actually go out and put a branch, you know, at every village essentially, right? While you could do multiple agents in the same village. And so from that perspective, we have always needed the agents to increase the reach of the branches and the banking networks. We don't have enough ATMs, you know, just roughly, broadly, to serve this population at the right cost, you need to be able to get an agent very close to them and provide these services, you know, at a much lower cost. But obviously, they're going to be more costly than digital. They're going to be more expensive than people walking into a bank branch. Sorry, less expensive than people walking into a bank branch. And for the user, the cost of accessing the services is very low because they don't have to travel you know, multiple hours to get to a bank and do the transaction. So from all perspectives, this agent provides a very good, it's a sweet spot for us to be able to service this user base. Digital sort of, you know, with self-serve will kind of eventually move away from this model I mean, India went away from the public call office, when the smartphone, when the cell phones came in, right? We will eventually do that as well, right? But the point is that for a long time, we will need this agent network to supplement the branches, to provide training to users, to make sure that they get financial services across the board. And I think that's the, I actually see that for a very long period of time, right? Though, talking 25 years, it's a different story, but 5-10 years, I think the agent networks are going to be here and will play a very important role in serving this user base.
And private sector is already starting to participate in that, right? So in addition to government-led CSCs, you actually have the big Sahaj networks, you have Dehat networks. We are seeing a lot of these models emerge now in the agri system where they're saying, at the farm gate, we want to provide the farmer with procurement, with inputs, as well as financial services. So things of that nature are emerging, and if folks find a way to make money without exploiting the poor and the farmer, see, exploitative models will not sustain. The sustainable models will be those that have enough value in it for all participants.
So I'd just like to come in a little bit here because, I think that COVID-19 is basically like a real-time audit of the physical plus digital infrastructure that has been sort of the hallmark of India's financial inclusion attempts. And Dwara, we at Dwara, we consider low-income households to be our primary stakeholder. And so we have been following very closely how the PMGKY scheme, whether it has been successfully reaching the last mile household. And we are very, very disappointed with how things are playing out. There is a serious problem with access point density in the country. And there are a lot of problems with agent incentives. So we have studied this very, very carefully, especially for rural households. The incentives commission structures for BCs and CSC operators, even before COVID, were found to be grossly inadequate, with most BC agents performing below or even close to their break-even point. Village level entrepreneurs that were operating CSCs have also reported dissatisfaction with their commission rates. So even when there are well-defined contracts between the bank and the BC agency, the sub-agents that are hired by BC agencies continue to be poorly paid with no fixed salaries, low commission rates. So, I mean, we have been doing some surveys to find out if the cash payments from the PMGKY welfare schemes have been reaching the last mile consumer, and the results are quite disappointing, actually. So I think that one of the things that COVID-19, I think, has done is show us that it's always I think for the near future, at least, if not for the long term. In India, you can conceptually unbundle digital payments from bricks and mortar or human mediated banking, but the practical reality is that the two are joined at the hip. And providers even if providers prefer digital to cash for a variety of reasons, it is important to provide a physical plus digital infrastructure. And by physical, I'm including human resources, meaning agents, in some form to the end user. So at this point, I think the COVID-19 has exposed a lot of problems. I think those can be opportunities. But I think, again, they have to be recognized as such by among others, the regulators as well.
That's a great point. So, I also want to sort of say, in terms of thinking about the incentives that that agents should have, I think, Anjali, I completely agree with you that a big part of the incentives in terms of the end user do relate to sort of what financial benefits do you see accruing. And I think one value that is not necessarily sort of a level, but relates to the dispersion of income is related to the consumption smoothing value. So if you if even if fees sort of remain fairly low for the outside options, non-digital outside options, if you're able to sort of very quickly send a small amount of money somewhere, that's we've seen real value in a more developed setting of apps like Venmo, et cetera, that are
Absolutely.
able to.
Yep.
You go out to dinner and you can send $5 to your friend, and that's totally feeless. I think that's like a lot of value of like sort of small transactions. I guess on the on the point of agents and the sort of sustained need for agents, though, I do see potential problems coming back to the unit economics. How, Sanjay, to follow up on what you were saying, is it possible to have a sustained costs related to maintaining agent networks and remain profitable in the long term? Does that extend the sort of time to profitability for these startups? How do you see that playing into the sort of balance sheets of these firms?
So if you look at the agent networks, I mean, they have a certain amount of technology costs and business development cost, which allows them to integrate with banks and banking partners. And then there's a field operations cost. And agent networks that have reached a certain scale have actually become viable. So if you, but it doesn't happen at a small number of agents. I think it's at least around 20 to 25,000 agents at which this operation starts to become viable. And the rates the banks pay the networks are quite low. And a large part of it actually goes to the field agent on the ground. And even that is not considered sufficient. I mean, Anandadeep is right. A lot of agents, when he talked about going inactive, was partly for that reason, because they were not getting the kind of income that they would have liked to get. But on the other hand, it was, so it is very low income that they get. But on the other hand, it's also typically an add-on job, right? I mean, you're running a store in the neighborhood. You also add your, you become a banking agent as well and provide additional services. So so with an incremental income model, I think we have found that you can make it work. The other fees that actually works, interestingly, sort of goes away the digital story, is the remittance. So when a migrant worker sends a remittance in cash, they go to an agent network to make the remittance happen, and they pay a fees of 25 to 30 rupees per remittance transaction. And they're very happy to pay that fees. The money reaches instantaneously. And a lot of the revenue that the agent networks make is actually through those fees, where the customer is paying and not the bank that's behind you, right? While typically if in a village you go and do a cash in or a cash out transaction, the money is paid by the bank. So where the customer is directly paying, the model has worked. It's just true even in, we look at Kenya. I mean, there the customer pays for all of these transaction charges. It's not free. And the usage is still high because people see the value and they're willing to pay it. And that's where I think the market dynamics work out better than if you mandate a fee which is low and do it from the back end. I think the power of the customer making a payment, if he feels the fee is right, is very, very high. And I think we need to start to see more of that happen, right? I mean, and you can't have it so high that it is exploitative, but I think it can't be so low where it's exploitative for the agents, right? So I think, and Anandadeep pointed that out very well. So I think, I do think agent networks will work. I think that over time, there has to be a little more loosening of where, what people are worried about and make those transitions happen.
Great, thank you. Let me turn it over to some of the questions that we're getting from the audience. Anonymous attendee asks, given the low levels of financial awareness and literacy amongst large portions of the Indian population, what are some of the risks of fraud in and over digital payment platforms? And as a follow-up, sort of what are possible moves that these platforms can take to preempt or build in consumer protections to ensure that fraud reduces? You can go to anybody who is moved to jump in.
I'm happy.
So I have a view about this. Sorry.
Let Indrajit go ahead, please.
Yeah, no, I have a view about this in so far. I think, the same reason that makes the unit economics so difficult in this space, at least in the near term, also is a protection against fraud, because these are very low value transactions. There are low value. I mean, especially when you look at low income households, poor households. How much are you going to be able to amass through fraud? Not, I mean, you'll really have to get very, very large volumes in order to make fraud worthwhile. And so that's one point. The second point is that, in village communities, and I think this is a point that Anjali also made, that it's hard to defraud customers and not suffer the consequences at the level of the entire village. So it's not just you're not just defrauding one customer. News travels quickly, and trust takes a long time to develop, but it dissipates very, very quickly as soon as there is a violation of trust. So I think that I mean, I personally am not so worried about the danger of fraud in this space. I mean, I think there are other dangers, other risks. I'm less worried about fraud on a massive level.
Yeah, so Sundardeep is actually very right. I mean, the data on fraud shows that while you do hear of fraud occasionally, it's not yet at the level where it would rise to a large systemic concern. But however, from the tech perspective, we always advise people to build fraud detection tech before fraud happens. And so, so NPCI actually does have a fraud detection system in place, as do most payment system providers. They do monitor transactions for things that are sort of happening, which are exceptions and so on. The thing that is related to fraud, where you're not seeing enough effort, and that's because, is really the grievance redressal. And to me, that is one of my pet peeves, that we don't yet have enough of that, where, when things go wrong, it may not be fraud. How do you go and get it fixed? And to me, that is actually a big mental barrier for anybody using digital services. And I worry about that much more than I worry about fraud.
Yeah, plus one on that one. Plus one.
I think I absolutely agree with that. I think you see this with the adoption of all kinds of technologies, right? That when you give away fancy cook stoves that were engineered at MIT's D Lab, to rural households, and then they break down, nobody within 1,000 miles knows how to fix them, and so then that cook stove lives on the sort of back shelf of of the house, and instead of sort of being used every day. So I think in the same way, if you don't, I think ultimately grievance redressal is really important, and the agent networks can play a role in that. And the question is sort of, how do you incentivize them to actually follow up? And, beyond making that first sale, do they need to have some skin in the game to keep the sort of ball rolling and tackle barriers as they come along?
So see, markets like India, Kenya, basically where we think about digital inclusion for the poor, particularly on payments or financial services, they are Maruti type markets, right? So why is Maruti the best selling automobile in India? Not only because it's great value and very good design, it's the easiest to fix. You can break down on any little podunk road anywhere in India, and you'll find a mechanic to fix it, right? So going back to grievance redressal, what works in systems like ours are simple solutions. So the design has to be simple, easy to use, and if it breaks down, easy to fix. So the process has to be easy to use and easy to fix as well. So both the interface, the process, and ultimately it's about mindset. So grievance redressal is also a mindset, right? It's the system's mindset around customer service. And you see this in high quality customer service processes where they are keen to address the grievance of the customer, and others, and it's not limited to digital. Most things that come in public services for people have not great grievance redressal mechanisms.
Yeah, that's fascinating. I think it's potentially really important, and we see it in some of our own work with respect to worker voice in factories. If you provide means for grievance redressal, you actually see greater retention at firms, and you actually see improvements in sort of bottom line outcomes like attendance that feed into productivity. Same thing with technology adoption. If you make it easy for people to get customer service and make their experience easier when they run into inevitable difficulties, you're going to see more retained usage and loyalty. So that's fascinating. Let me turn it to another question that we've gotten for Sanjay. In particular, the question says, did fintechs use the regulatory sandboxing opportunity provided by the government? Did we see new innovations mushrooming from this effort? And is the second window going to open up soon?
So the first window opened up last year, and some set of ideas were taken into the sandbox. And I actually haven't followed up, so I don't know the status on those. But what we have seen is that the number of, the demand for sandbox is quite high across the sandboxes. The insurance regulator has their own, and the banking regulator has their own. And one of the things that I would have loved to see is a common sandbox across financial services, because while the regulators are siloed, and most people want to offer combined services, and you want to be able to offer a savings product and a payments product at the same time, right? Or insurance and something else, and would love to see that happen, but that hasn't happened. But we have seen on both the regulatory sandboxes a fair number of applications come in. But I don't think anybody has made it out of the sandbox yet, right? And that's got to be the important point, is that when you come out of the sandbox, how do the regulators enable that innovation to become a larger scale? And we are, I think, in that point in the process where we should see that happen soon.
So big plus one on that, the unified regulator for the fintech sandbox is, I think, something industry has been asking. And there've actually been some good, useful, mutual trending towards positive dialogue. But anything regulatory does, and in my view, should take time. The regulator should not rush in. But one thing that has happened, Sanjay, and ask Sanjay's views on this as well, is the adoption of the eKYC, the unified eKYC, and the use of the DigiLocker, which now enables multiple fintechs to access the customer data without actually accessing the customer data, right? So validation without necessarily accessing. And so it leads to better privacy and data security.
I'm happy to see that take off. I think one of the, there were limitations earlier, which I think over the years have been smoothened out. And it's good to see that happen, because it brings people in much more faster into the system. It reduces the acquisition costs. It reduces drop-offs. I mean, we have had startups which went in and tried to get a customer, did everything, and then customer is ready, the startup is ready, but something drops, and you just can't close the transaction. That just is so painful to see, and I'm glad to see that we've gone past that.
So let me take one last question from the audience, and then we can send it back to Sonakshi to wrap up. The Dipanshi Bhardwaj asks, with the recent COVID crisis, biometric authentication has become as risky as cash in terms of transmitting infections, resulting in temporary suspension of PDS and attendance biometric authentications in some states. Did this also have an impact on the BC agent network? And I guess more generally, I'm interested to hear sort of, as you see, kind of touch points becoming potentially more problematic with COVID, is that going to change biometric authentication processes in general?
Be interesting to see how it plays out. But in the BC networks, most of them actually brought in the sanitizers and would clean the fingerprint sensors frequently. I don't know if after every instance, which they should, but that's what they're advised to do. We have seen that happen. So that continued, while in PDS, I think they paused. I think for two reasons. I think part of the reason with PDS is also, I think the urgency of giving grain out beats a lot of other requirements. And so I think that while, if you give cash out to the wrong person, the risks are very different. So from that perspective, I think they eased up on that, but out here they put in more sanitization so that you could handle the payments in a different way. And on the long term, I think we're going to see it change. I mean, we have not introduced face authentication except as a secondary. In Aadhaar introduced, you could do biometric plus face, but not just face alone. I don't know if they'll reconsider that, but that's a possibility that you could go to face auth. The issue with that is, of course, I'm not convinced I know exactly all the accuracy levels, etc. But that's why they introduced a secondary but not primary. We may see that certainly come up. Iris is non-contact. That could be something that could be brought in as well. So those are two options where biometric could be retained in a non-contact manner. I haven't seen any movement towards either of those.
Okay. Anjali or Indradeep, would you like to weigh in on authentication?
Sure. We actually looked at public sector banks, incentive structure for BC agents during COVID-19. And so we found that, that a BC agent was receiving a one-time payment for sanitization equipment. And there was a compensation to the kiosk operator or the sub-kiosk operator. However, the compensation only came in the case of death due to COVID-19. So, there was a fixed incentive per month. If you worked for a minimum of 21 days during the months of March to May, there was a transaction-based incentive for those workers who undertake more than 40 or more transactions per day with a per day cap of rupees 150 per CSP. So yeah, we found that some of the incentives that were introduced have a salary-like component to them, but the conditions for the receipt of these benefits left much to be desired. So for instance, in the case of hospitalization for COVID-19, the medical costs incurred by the agent were not being reimbursed. And so things like that meant that there was a fair degree of freeze up of the BC network due to the fear around contagion.
Absolutely. Well, thank you. This only leaves a couple minutes, so I'm going to hand it over back to Sonakshi. From my end, I just want to say, thanks to all the panelists for engaging in the discussion. It was very, informative, and I learned a lot from our speaking, and I hope we keep in touch. And thank you to ID Insight for hosting this. It's been a really nice discussion.
Thank you. I think it was great. You did a good job moderating, and wonderful panelists, good discussion. So great.
Thank you all.
Yeah, I want to echo both Ach and Sanjay and just say thank you so much to all the panelists for engaging in an extremely important and timely discussion. And I know that there's a lot of interest on the study, the results, and so a lot of that will be available on our website and on the Good Business Lab website as well shortly. And in addition to that, we also have a lot of other research connected to some of the issues that were brought up. So Aadhaar authentication, relief related to COVID, that's available on our website. In case people are interested, please go on and check that, and we'd love to engage with you on those different things. Thank you again to the panelists for having this extremely important discussion today, and when we look forward to continuing this conversation. Thank you, everyone.
Thanks. Bye.
Thanks a lot.
Thanks all.